to growth stage to scaling stage to major expansion to 7-8 figure business. Well, that's exactly what we're going to be talking about today, is how you can create an unstoppable funding strategy to get the money you need when you need it, aka funding on demand, and be able to get the funding that you need on demand from the startup stages of your business even through major expansion. What's that look like? How do you do it? That is exactly what we're going to be diving into right now. We're going to be helping you develop your own unstoppable funding strategy. So that being said, before we dive in too much further, I want to remind you that we are doing a free challenge called Business Loan Broker Challenge, where we teach you how to offer business credit financing as a service. So if you're interested in taking part, go to businessloanbrokerchallenge.com. And at businessloanbrokerchallenge.com, it's the last week here of July in 2023. You can go through and you can check that out, and you get the free training. We're going through about 3 days of solid training. We bring lenders to you everything you need to succeed. Okay, so that being said, and you can go ahead and check that out at businessloanbrokerchallenge.com. Okay, so that being said, what do we talk about? We talk about unstoppable funding strategy. What I mean is this: you need to be able to have a strategy to be able to get the money you need when you need it. It doesn't help you if you are having a bad month and you need money and you can't get the money. It doesn't matter if you want to, it doesn't help you if you want to expand and you need to do more marketing, or you want to acquire a business and you can't get the money when you actually need it. So we've got to be able to create a strategy for you to be able to get the money you need when you actually need it. And when I talk about an unstoppable funding strategy, that is exactly what I'm talking about. So the first step of this is you need to have a game plan. Okay, being an entrepreneur, there's a big difference between being proactive and staying ahead of things and being reactive and staying behind it. And in the funding world, I spent decades here. You never want to be behind it. You always want to proactively be out looking for money. Let me give you an example. Last year, when we knew the Fed was increasing rates, we went out and got funding. Why not? We didn't need it. And usually I say only get loans when you need them, but not in this case. The reason we didn't get loans when we needed them or when we didn't need them was because we knew rates were going to go up. We wanted to lock the money in so we had it available. So that's staying ahead of things, right? Being able to get credit lines, being able to get business credit cards, being able to build business credit before you actually need to use the credit is staying ahead of things, not behind it. And that goes a long way in lending, because what happens in lending is that in lending, lenders do not like to lend to people that are in trouble. They do not like to lend to people where the sales are declining, the revenue is declining. That puts you in a very bad situation. And let's be honest, that's when you typically need the money. So the key here is to stay ahead of it, not behind it. And you can only do that really if you have a solid game plan in place to be able to do so. So you want to make sure that you have a game plan in place to make sure that you can get the funding. Now, what is funding? Well, funding or financing, it's basically just the act of getting money for your business. And there's really a couple main components to this. There's debt and there's equity. Now, equity is where you get private investors and angel investors and people that are venture capitalists. And then we talk about debt. These are loans, these are credit lines, these are business credit cards. So when we talk about funding, we've got to know these two different areas, and we've got to know the area that we want to go look in. Now, most of us are going to look on the debt side. We're not out talking to angel investors. We're not going to venture capitalists. We're not going to equity crowdfunding sites. We're not exchanging ownership in our business for money. Now, you can absolutely do that. But again, that's equity financing. Debt financing is more of what you're probably interested in: loans, credit lines, credit cards. But that's an important part of it. You need to know the difference between those two and know which one of those are actually going to work for you as well. Okay. Now, that the other part of this is that you want to really think about what types of funding are out there available for you. And the key to that is to know what kinds of business funding strengths that you actually have. So that's one of the first things that you really should be thinking about. By the way, if you're just coming in, give me a shout out. Tell me your business name. Tell me where you're coming in from. I would love to give you a shout out and say hello. So what we need to do next is we've got to figure out, if we need money right now, we need to see where our strengths lie. What are our strengths? And lenders classify this as the 3 C's. It's a super simple formula that I found that within less than a minute, probably 30 seconds, tells you exactly the kind of money you can get right now and tells you what you have to do to get other kinds of money. The 3 C's are this: cash flow, credit, and collateral. It's that simple. So when we look at this, you've got to figure out which of those 3s are your strengths. So for example, if your strength is that you have consistent cash flow for 6 months or more in your business, maybe you're generating 5 grand a month, 10 grand a month, 7 grand a month, 20 grand a month, and you've been doing that for 6 months or more, that is a strength. That opens up PayPal, Square, Stripe, lines of credit, terms loans, revenue lending, merchant cash advances. All of that is money you can get based on your actual revenue, the 3 C's. So now what we're talking about is we have cash flow. But here's the interesting thing about the 3 C's formula. You only need one, you don't need the other two. I'm going to show you how this works within a minute here. So the second C is collateral. So the question is, what assets do we have that can be served up as collateral? Do we let our customers pay us on terms, and do we have account receivables? Do we have purchase orders? Do we have equipment that we want to buy, or equipment that we own, or inventory we want to buy, or inventory that we own, or e-commerce inventory that we're going to sell online? Do we have vehicles? Do we have cryptocurrency? Okay, so for example, I just did a YouTube video that's going to be released here in the weeks to come on how to use cryptocurrency to be able to get financing for your business. So the question is, do you have an asset in or outside of the business that can be served as collateral? Maybe it's stocks, bonds, 401ks, IRAs. Maybe it's somebody else's stocks, bonds, 401ks, IRAs. Maybe it's somebody else's equipment that you're going to use. But an asset that you can leverage as collateral is that second C. It's collateral. The third C is credit. This has 2 sides. Personal credit and business credit. So the personal credit, do you have good personal credit? Or do you have someone around you that could be a signer that does? Family member, friend, potential investor. If they have good credit or you have good credit, you could leverage that to be able to get financing. So when we look at these 3 individually, cash flow, credit, or collateral, your job is to figure out which one of those is your strength. Now, if you have more than one of those as your strength, I have good credit and I have consistent cash flow, well, then that could open up the door for SBA loans or term loans or more kind of financing. If I have all 3 of those, that's definitely putting me to an SBA loan category. But if I only have one, I don't need the other 2. So if I have cash flow, I can get approved with no collateral and bad credit. If I have good credit, I do not need cash flow and I do not need collateral. If I have collateral, I do not need cash flow, meaning I can get it as a startup, and I do not need good credit. So all I need is one of those C's to get money. And if I'm doing a real assessment to be able to develop an unstoppable funding strategy, I've got to know which of those C's I have and which one of those that I don't have to know what to work for. So for example, I'm just launching my business. My credit's okay. I have somebody else that's going to sign as a signer. They sign. I get startup financing, credit line hybrid, $50,000, $100,000. It gives me what I need. Good. It's only going to be temporary. I'm going to spend that money. I'm going to need more. Now I know the 3 C's. And while I've got that money and I'm using it, I want to be working on fixing my 1 C, my personal credit. I want to be letting my customers pay me on terms and obtaining account receivables or that as an asset. I want to be generating revenue for my business, taking the startup money I got, putting it into marketing and advertising, growing my revenue to open up cash flow. So now I'm opening up those other C's along the way. And therefore, when I need money again, now I've got cash flow. Now I can unlock that kind of pillar of funding. Now I've got some collateral. I can unlock that pillar of funding. Now I can use my personal credit. I can unlock that pillar of funding as well. So knowing those 3 C's is very important. You can also go check it out. I've got, I think, a guide here on 27 different ways to get funding to be able to grow your business. I'm not sure if I have that on here or not as a guide. I don't think I do. But you can go to, I think, creditsuite.com/27, the number 27, and that will get you to that guide as well. Now, the next thing we've got to do is we've got to take a deeper dive. I talk about this a lot, but it's important, is that we've got to make sure that we've built our business where it is fundable. It's very important because when we're going to get money, we need to make sure that we look credible in the lender's eyes. If we don't do this, it causes a serious delay in our ability to get funding. Let me give you a real example. So when I had a mortgage company that failed, I had debtors that I just could not pay on the personal side, and they got judgments against me. And I paid those judgments off a long time ago. But when I applied for an SBA loan a while back, they pulled up judgments that weren't even mine from my LexisNexis credit report. And they said, hey, you got to prove that these things are paid off. Well, they're not even my judgments. How do I prove that judgments that aren't even real are things that I paid off or that they're not real? It's hard to prove a negative. So I did it. I went to the county and I went ahead and got all their proof and everything from them. I could prove that they have no record of said judgments. And I proved it to the lender, but it caused weeks delay for me to be able to get the proper proof for them. So if I need money right now, that caused a 3-week delay because I'm not responsibly looking at my LexisNexis credit report to know that there are potential problems coming up, right? So this is the importance of fundability. If you don't have it, it causes all of these unnecessary delays that then make it harder for you to get the money that you need. Now, the easiest way to do this is by improving the aspects that the lender looks at. Now, again, we actually have with our clients, we call this the fundability score to make it super simple, right? Our clients have a score that tells them how fundable their business is, and they can easily come through and correct things and then make their score go up. It's very simple. We walk them through what's on the application. But even if you're not a client, you need to be knowing that what you put on your application controls how fundable you are. Having control of your LexisNexis credit report, your check systems credit reports, bankruptcies, judgments, leads, keeping an eye on your personal credit reports and scores controls your ability to get money. Business credit. Do you have the right distribution of accounts across the 3 bureaus? Do you have negative items that need to be disputed? Do you have your reports activated with each reporting agency? Lenders ask for financials. Do you have those financials? Do you actually have the financials needed that lenders are going to ask for? And are they legit? Are they set up the right way? Do you have your foundation set up the right way? Your name, your address, your phone number, your entity. Are you in a high-risk industry or not? You need to know these things because this is what gets over 60% of loans denied. 6 out of 10 are denied not because of credit or income or anything else. It's because you don't have this set up right. You don't even look credible to the lender. So you've got to adjust this fundability. The fundability is one of the most important aspects of getting funding. And the reason I talk about it so much is because so many clients come to us. Here's the story. Ty, I'm ready to give up. I got denied. What happened? I went and tried to get an American Express card. I went and tried to get a loan. They denied me. Did they tell you why? No, they didn't. Let's take a look. Oh, your Secretary of State record doesn't match your application data. Did you know that? No, I didn't know that. Let's update Secretary of State so it's accurate. Now it is. Now I want you to do me a favor. I want you to go back to American Express and apply again. I just did apply. I know you did, but you applied with incongruent information. Go apply again. And they go back and apply and they go, I just got approved for an unlimited or a no limit Amex card. I'm like, yeah, that's one change and it got you that approval. Listen, if you watch my webinars that I go for an hour and a half on, I'll have testimonial after testimonial after testimonial where the same thing happens. We change one thing, they go back and get approved. One thing, they get approved. One thing, they get approved. Because there are lenders, for example, like Walmart or credit issuers like Walmart, for example, that will not give you a credit card if you use a home address as your business address. They won't do it. Amazon will, Walmart won't. Now, if you know that and you're educated and that's taught to you, then you go back and you get a virtual office through Alliance. Well, then that fixes that issue and you go back and fix that one thing. You go back and get approved for Walmart. We see this happen with thousands and thousands and thousands of people. They fix one thing on fundability, they go back and they get approved. And they're like, I can't believe it was that easy. And I'm like, well, it's not that easy. It's like the guy that fixes the submarine story. I'm going to mess this thing up. But, this guy comes in and they say this thing is broken and he comes in and he does this thing and he hits a hammer and he hits it one time and it fixes the issue and he serves them a bill for $50,000. And they're like, well, why are you serving me a bill for $50,000? All you did was hit it one time. He's like, no, hitting it wasn't what you were charged the $50,000 for. Finding where to hit it was what you got charged the $50,000 for. Okay, it's exactly the same thing. You have to actually know what's causing the problem and fix those things, or you're not going to be able to get approved. So you got to recognize what lenders and credit issuers are looking for and set your business up and structure your business where you have those things. Because once you do this once, you never need to do it again. And by the way, if you're just coming in, tell me where you're coming in from. I'm not getting a lot of shout outs today. So give me your business name. Tell me where you're coming in from. And give me your state that you're in too. I want to know what industry you're in. I'd love to know your business name. I'd love to give you a shout out right here on the actual stream. So if you come in and say hello, I'd love to give you a shout out. So we've got to make sure that business is set up where it's fundable. We have an entity set up. We have an address and a phone number set up. We get our LexisNexis credit report, our check systems credit report as well. We want to make sure that we have a separate business bank account set up. Our business is separate from us. That becomes very important. The next thing is we've got to make sure that our financials are at the ready. I have a folder on my desktop that is like my financial ready folder. It has the most recent bank statements of the business. It keeps my most recent personal bank statements. I keep my tax returns for all my businesses in there. I keep my tax returns for me personally in there. And whenever I get a P&L from my accountant or a balance sheet, I put those in there as well. So I always have that stuff ready. And the reason for that is that I buy exotic cars. I just bought an airplane. Like that's been my dream plane that I've wanted for 10 years plus. I buy businesses. I get funding for my businesses. 100% of those things require those financial documents. So I don't want to go apply for a loan and then go, oh, I got to go get all this stuff together. Okay, my best friend was like that. He went to get an SBA loan to buy a business. He said, Ty, I'm never going to do that again because they asked me for all this stuff. I'm like, yeah, take all that stuff, put it in a folder and have it ready. You never need to do it again. And now he's out buying more businesses because he realized it's easy if you have that documentation ready. Going to dig it all out is what is the problem. Like if they ask you for 3 years tax returns, personal and business, and you have those in a folder where you could just attach them, well, then that's no big deal at all. That's simple to get. But if you got to go get those and scan them and then that's a whole nightmare. So have those financials ready. P&Ls, balance sheets, bank statements, tax returns. It's no big deal that when you get your bank statement for the business at the end of this month, that you just download a copy and put it in a folder. It's super simple. And this makes you ready for funding when you actually need it because all of those documentations are already together. The other thing you want to start thinking about is you have to start separating your personal and business credit and your personal and business financials. A business bank account, a personal bank account, business credit, consumer credit. I'm getting credit cards to fund the business. They're in my business name linked to my EIN, not linked to me personal. I'm using my personal credit cards for personal reasons, not to try to fund my business where it messes up my utilization. So many things that prevent people from getting denied are caused by these things. So I listened to a lot of our account executive sales calls, and I was actually listening to one this morning where this exact same thing happened. Do you have good credit because you're trying to get startup capital, and we can get you 50 to 150,000 in startup capital if you have good credit now? No, I don't. Why don't you? My credit used to be 700. Now it's in the low sixes because I use my personal credit card to fund my business. Great. And now you need business funding and you can't get it because you use personal funding to try to fund your business. You did it the wrong way. So this happens all the time when you're not separating yourself from the business. You need to separate personal guarantees. You need to separate bank accounts. You need to separate what you're using the credit and financing for. And you need to stop using personal funds to fund your business. Now, more than likely, you're doing that because you've been struggling to get business funds. That's why you're here in this training. I'm teaching you the path to actually get you business funding and get you away from the actual personal funding. And that's why we want to do it. We want to keep our financials together. We want to keep them in a place that's easy to access. We want to start separating consumer credit. We want to start separating commercial credit. We want to start managing our expenses the right way, right? There's all kinds of apps out there we can get that actually apply, that actually are tools we can use to manage expenses that also report to business credit reporting agencies. So we want to use these tools to manage our expenses. We want to make sure that our business expenses are going through our business credit cards or our business bank account, not our personal and vice versa, for example. These are things that lenders are asking for. The other thing that we want to make sure of is that we have our taxes filed. Be ready to file your taxes. Stop filing for extensions. When you file for an extension, what a lender's oftentimes going to want is detailed audited financials. Those are a nightmare. You got to go to an accountant and pay them all kind of money to get audited financials. So the way around that is get our taxes filed on time and have those taxes at the ready when the lender needs them. Now, don't get me wrong, okay? In a lot of cases, you don't need tax returns. I need them for SBA. I don't need them for revenue lending. I need bank statements for revenue lending, but not tax returns. I don't need a balance sheet or a P&L statement for a merchant cash advance, but I need it for a term loan. So again, for some kind of financing, you need it, and some kind of financing, you don't. That's the way financials work. That's the way fundability works. That's why if you do everything I'm telling you today, then you're going to be set up for any kind of financing you actually want to get. The other thing is you need to really be thinking about running a profitable business. So many of us get caught in this trap where we say, hey, look, I take all the money my business makes and I reinvest it. That's our excuse for not running a profitable business. But here's the reality. The reality is your business will eat up every dime of cash flow you give it to eat up. It's like the Cookie Monster and cookies, but it does it with cash. It will eat every bit of cash you give it to eat. Then there's a great book out there called Profit First, and Profit First shows you exactly how to do this the right way. You set up a handful of different bank accounts. You got your expenses account. You got one for taxes, for example. You've got one for profit. You decide what your profit margin is, 5%, 10%. And whenever the money comes in, you take 5 or 10% of that money and put it in the profit account. That money is off limits. You do not touch that. That is your profit. Okay, that is for your distribution. It is not for anything else. Now I've got money in the tax account. It sits there for that reason. Everything else can wait. Look, now you're going to say, Ty, look, if I did that, I wouldn't have money to pay my bills. I'm going to ask you a question. Have you ever had money deducted from your pay in the past for things? And if you've ever done this, a 401k, whatever it may be, you notice that you're just fine without that money. And one of the easiest ways to take money and set it aside is to take it from the very beginning and set it aside. And you never even notice the money gone when you do that. But you do notice it gone when you wait and then you take it out and you know it's there. So take the money immediately and put it in these separate accounts. Now you've got a profitable business. It helps many of your credit scores because you have multiple different bank accounts, which lenders and your bank scores really really prefer that. And the other thing that happens is you're running a profitable business. You're going to get distributions every month, every quarter, every half, biannual, depending on you. So now you're actually able to come in here and take money out of the business and run a profitable business, which is a much more rewarding way to run a business if you're actually profitable and set that money aside. So in order to run a profitable business, we need to have a plan. We need to know what we're doing with the business. We need to have a separate expenses for us to put profit in. We need to keep our books up to date. We need to keep our financials there. We need to separate expenses. All the things I've told you today are things that will help you have a profitable business. But another way to have a profitable business is to actually stop using cash to buy things and start using credit to buy things. Okay, so what we want to do is we want to start building business credit, and we want to get credit at every retailer that we buy stuff from. I buy a lot of stuff at Amazon, for example. You may too, okay? Amazon they have like their trucks automatically drive to this place to drop stuff off. That's a place I do a lot of shopping. I buy a lot of stuff at Apple. I buy a lot of stuff at Best Buy. It doesn't make any sense for me to not have business credit at them. I want to have $20,000, $50,000 credit limits with every one of them. So now, instead of me going to buy the Apple computer, I can actually use credit. Now, I can pay that credit off before interest accrues, but by doing it this way, we oftentimes get rewards points. So if I use my Marriott card for whatever spending I spend, now I get rewards points, and now it makes my hotel stays free. If I use my American Airlines credit lines, which I do because I fly a lot with American Airlines, now I get status. They upgrade me to first class all the time. I'm flying all over the world first class at $0 extra just because my status is so high, because I'm using my Amex, or I'm using my Citi credit card for American Express to buy all kinds of stuff. So I'm getting rewards points for free flights. So I take flights all over the world and I don't pay for them because I get those points. Now, you can get points and get groceries, and you're able to get office supplies and travel. So by doing the normal spending I'm doing, I'm getting all these rewards just because I'm using credit cards instead of cash to do it. And it also leaves more cash on hand for the things I need more cash on hand for, like payroll. I can't use an American Express credit card to pay payroll. So having cash on hand to make sure I can pay payroll helps me. And then using my Citi American Airlines credit card to buy the other stuff, and then paying it off before interest accrues helps me. So now I come in, I choose when I have to pay that bill off. I don't have to pay the whole thing now if I don't want to. I'm getting points and extra rewards points just by using that credit card regularly. And I keep more cash in the bank account for things like I may need it, like expansion, for example, or for example, like I might also want to use it for payroll or anything else. So being able to do that is going to help you a lot too. It frees up cash flow and gives you the ability to wisely use business credit to be able to grow your business instead of coming out of pocket with all of that money. So that being said, if you want to learn more about getting money for your business, you can simply scan this QR code to go to creditsuite.com/consult. Our team will do a free fundability assessment for you. We will tell you the things that are wrong on fundability, what to fix to make them better. Our team will give you tips and tactics to build business credit, to start building it or expand it from where you are. And we will also talk to you about all the financing you can get right now. Here's the loans, here's the credit lines you can qualify for. It's 100% free. You can scan the QR code or go to creditsuite.com/consult to take part. So I'm going to go ahead and wrap up. Thank you very much for tuning in today. Now you know how to create an unstoppable funding strategy to get money on demand when you need it. If you missed this training, go back to the social platform that you're watching it on and watch it in its entirety. And do not forget to go to businessloanbrokerchallenge.com, 100% free event that takes place the last week of July that teaches you everything you need to know to offer business credit and loans and credit lines as a primary or secondary service. Look, we got clients making $500,000 to $1 million this year alone offering business credit and lending. That's not even their primary business. Like, that's a secondary business for a lot of them. So if you'd like to learn how to do that, everything you need is in this 100% free challenge, which takes place at the end of this month. Businessloanbrokerchallenge.com. Check it out. Thank you all very much for taking the time to tune in. I look forward to seeing you on our next training where we talk about more cool ways to get the money you need to start and grow your business. Take care. Oh, wait. Danny says, hey, do you guys personally speak with us? Phone call to explain the process? Yeah, we absolutely do. All you have to do, Danny, is just give us a call. And if you give us a call or schedule time, then we will walk through and talk to you about the process, talk to you about fundability, building business credit, and lending as well. Scan that QR code or check it out at creditsuite.com/consult. Thank you very much for tuning in. I look forward to seeing you next time where we talk about more cool ways to get the money you need to start and grow your business. Take care. Have a great day.